10 years has passed. ESG is now almost every of us agree it's important, but we very often disagree. What is more greener? For example, some people claim the electric car Tesla is very green, but others argue that if you including the cost and the pollution produce those batteries, Tesla is actually not that green things. So ESG evaluation is very complex and many different measures often conflict. One measure is offered by MSCI for the firm level ESG, which is sometimes not disagree with Morningstar Sustainalytics or the Referisk or Thomson Reuters Asset Fall. So they have all different things. My first question for the panelists is, what do you think should be a good criterion for ESG measurement? Some of you mentioned there is this new international sustainability standard, but very often a lot of this international new, especially at the beginning, very rough. Is that far away from the day-by-day things you evaluate whether it's the true ESG good things. So as investor, how do you choose and use those non-standardized ESG information to help your client to make sure this is truly an ESG investment? Let's just still start from the same order. Remy, would you like to talk about it? Thanks.
Sure, and clearly this question about the divergence of various ESG rating is one that has gone to be discussed quite a lot. So maybe a few things to highlight. First, what sometimes is overlooked is that in the ESG space, there are various ratings of scores that are done by entities that are solving for very different problem, very different problem. And so in particular, and I think Anne was sort of highlighting that aspect about making sure that there is a sort of long-term return for long-term cash flows, for long-term liabilities to pay pension. That's one objective, essentially, to integrate, ESG into an investment process in order to identify long-term risk or long-term opportunities for companies. So climate change, is a long-term risk. It's also on the green side, a long-term opportunity. And so if you're trying to help, through a metric to answer those questions, then you create a rating, which is really our philosophy as well, a rating which tends to put a lot of emphasis on a number of key material issues that would affect a company in a given sector. So for example, if you're a bottler, access to water is a really critical, issue. If you don't have water, you don't have a business, right? Very material. Now, if you keep the same topic of water management, if you take an advertising agency, you can do a lot of good things, in terms of managing water in your offices. It's a good thing to do, but it may not be a material thing, overall in terms of when you assess the risk of an entity like that. So if you take the world from a view of long-term financial assessment, you're building your metric, the rating, in a given way. But if you come from another angle, which is what you would call more of a normative angle, so you want to promote good practices in a certain dimension, then you will put the advertising agency that does a lot on water management and the bottling one at the same level, because they're both really potentially doing a lot, in order to promote a concept. And that may explain a lot of the differences if you're on between the ratings. And that's why if you, again, want to serve pension funds or asset manager and help in that process, then this materiality concept, is really important. And that can explain why certain ratings could be different. The other aspect very quickly is that ESG, in a sense, is blending three dimensions. Each of the dimensions, by the way, have quite a number of different sub-dimensions. And so without this materiality angle, then you're left with potentially putting a lot of emphasis everywhere on the environmental side and then ignoring governance or vice versa. And so that may explain, again, why there could be some big differences if you only look at the environmental part, for example, or only look at the governance part. You will have differences, by the nature of it. Maybe I'll stop here, not to take too much time, but that's, one element of, the discussion.
Yeah, it's clear, not an easy topic. Granville?
Yeah, just, Remy was, highlighting a lot of the complexity that exists in the ESG ratings landscape. And, over time, with better disclosure and better data, I'm sure the market is going to sort that out. But underlying all of ESG ratings, and a lot of asset managers and asset owners, create their own proprietary benchmarks or ESG ratings, many of them based on existing rating products that are in the market now. And underlying all of that is the need for consistent and comparable data. And that's where the SASB standards, which are part of the Value Reporting Foundation, come in. You have over 160 asset owners and asset managers that have licensed the SASB standards for various uses. You've got 22 of the largest asset managers globally that reference the SASB standards in their proxy voting guidelines. You need basic, sound, consistent and comparable data and market infrastructure to inform the conclusions that investors are trying to draw when they use ESG ratings products. And we've mentioned the International Sustainability Standards Board. The intention of the IFRS is, as the ISSB moves through due process towards a climate disclosure standard in 2022, that in the interim, that companies should continue to report against SASB and the TCFD and other frameworks in order to position themselves for compliance with what the ISSB will ultimately produce next year. Yes, there's a lot of divergence in the ESG ratings landscape. And over time, we very much believe that the consistent use of SASB standards and now the ISSB standards is going to reduce that range of difference to provide the market with better and more useful information.
Great, Laura. So BlackRock is a big player in the ESG market. When you helping your clients to choose this is true ESG investment, what kind of information do you use? Do you use, for example, the rating offered by MSCI, or you use your own internal standards?
We use both. We use a combination, right? So I certainly agree with Remy. I think Remy really framed the issue very well, and we certainly understand that ESG is trying to do a lot of different things, and it's important to think about this concept of materiality and what environmental and social and governance elements are really material to the creditworthiness or the profitability of a company. The way we approach it is obviously we have dedicated teams that do diligence data sets, and I would say it's also really interesting to see that there's a lot of emerging data sets in the ESG space. Maybe the big broad ESG rating providers are the ones that you mentioned earlier, but there's a lot of emerging niche players. They either adopt a different approach in the way that they capture and aggregate the data. It could be more real time, for example, through the use of some natural language processing or scraping news media and headlines and things of that sort with dictionaries built for that. Or it can be niche and sort of focused on specific angles of ESG. Think about data around real-time methane emissions, or some of these data that are used in some of in some areas of capital markets that are more real-time indicators of certain things that you're interested in. And I would say there's probably like every day some data provider that approaches us, and asking if we're interested in that. So we spend a lot of time due diligencing data sets and really thinking about, first of all, if they're robust, if we can trust them, if they tell us something useful, and if it's something that we can build into the investment process. One big question is, can we turn this into an index? Can this become an insight that is useful for the construction of an index, for example? Obviously, we're in that business here. And then, of course, BlackRock's a big firm, and so all kinds of different approaches to investing, from fundamental to more systematic, active and passive. And our investors have access to a large number of data points. We have, of course, the MSCI ratings integrated into our own risk management system, into Aladdin, and we have others as well. And so there's certainly a lot of opportunities for our portfolio managers, including the ones that are managing unconstrained strategies, to really think about, is this stuff relevant for what I'm doing, and how can I incorporate that information? So it really runs the whole gamut. I think that at the end of the day, the way we think about it is we sort of offer a menu of options to our clients, right? It's very much, the lens is really very much that of having our clients be the ones that make a decision around what amount of ESG or what flavor of ESG they want to incorporate into their portfolios. And so the menu of options includes sort of simple approaches that really are more focused on aligning perhaps with values. So it's approaches such as screening, for example. It's very much of a legitimate concern. I don't want to finance a certain activity. I don't want to put my money in tobacco. I don't want to put my money in controversial weapons, things of that sort. But then, of course, a different approach that our clients also choose, and we have, of course, products and options for that, is I would like to have a product that optimizes with a very tight tracking error, something very similar to a traditional benchmark, but also improves on certain ESG elements. It can be a reduction of carbon footprint. It can be an increase in the ESG score. Or another approach can be something that says, I would like to bet on the best performers in their own sector, in their own category, on sustainability. And so this becomes an exercise around picking the better companies, the ones that have better practices, the ones that demonstrate better alignment with sustainability within their own sector. So you can still build diversified portfolios, but you're picking we call it best in class, the leaders in their own sector or in their own space. And so there's really a lot of flavors that you can add to this, and ultimately choice rests with our clients.
Seems like even more complex. I guess big companies like BlackRock, you have your internal capacity to do this, but many of the small asset managers, they for sure don't have this capacity. They might have to heavily rely on the public index like Remy's company providing. But both of them still can do things, these public firms. It's much harder for private markets. And this is a CalPERS. When you guys do this pension funds, you do a lot of this private investment. In my imagination, it's going to be even harder to think about what is the ESG evaluation for those private firms. As a pension fund investor, what would you say about what do you guys do to choose ESG for private firms? Thanks.
Yeah, no, I think Granville, Laura, and Remy pointed out the fundamental problem, which is the lack of standardized reporting. So we are often in the world of a guesstimate or an estimate on things that matter. So the voice of investors in driving the standards and reporting, which can then go through the internal audit process, be signed off by the audit committee, reviewed by the auditors, that is the way that we will ultimately get the quality of information. Now, which then the next question is, well, what really matters? And that depends upon the investor. Even in the United States, where materiality is an important concept, but it's thought of as being narrow in relation to, say, the European approach. I would just like to reference that the Financial Accounting Standards Board definition essentially focuses on what the reasonable investor would consider to be of significance in the total mix of information. Sometimes people talk about ESG information must be material and we must be able to tie it to short-term financial impact. No, the US FASB approach, and this is backed up by the Supreme Court on this point, the materiality judgment is made by the investor. So if you look at CalPERS, first of all, our size really matters. We are a universal owner simply by having close to $500 billion that we need to be fiduciaries for. The second dimension that's relevant for us on materiality, and therefore that is the approach for us that defines the sustainability information we need, or the ESG data, as you're saying. And that's our long-term horizon. We have to generate cash every year, as I said earlier, but we've got to grow this $500 billion at 6.8% per year consistently for decades. So when we step back and look at risk to our portfolio, it's the systemic risks like climate change, like the stability of the financial system, the impact on natural resources. And we may not be able to find individual companies where this is material at the issuer level, but these issues roll up across our portfolio and over time to become systemic risks, and we need to team up with others to tackle them. In the private markets, it's both easier and at the same time more difficult. So that sounds like a contradiction, but let me explain. In private markets, our main exposure is through real assets and infrastructure. And on both of those asset classes, what we have done is work with other asset owners to build a framework for sustainability reporting. It's called the Global Real Estate Sustainability Benchmark, and also the same for infrastructure. In addition, we have a responsible contractor program in order to take care of reporting on wages, benefits, health and safety, employee engagement, and so forth. So in other words, the policies can be set. When we come to private equity, as I said, we've just launched a new initiative because there what we have to deal with is the limited partner structure. So this is where the general partners are actually in a much stronger position than typically an investor, even a very large investment manager like BlackRock or an asset owner like CalPERS, because typically the general partners have control of the company. Often they appoint directors who are professionally trained in the transition strategy that the company needs to make. So the challenge is to get the limited partners, CalPERS being one of the largest limited partners in the world. We know that our role as limited partners is to make sure that the general partner has this agenda for sustainability integrated into the business plan. So the new private equity data convergence platform that we've developed is intended to, if you like, in private equity, lift all boats. So I hope that's helpful. But I would also say, finally, that in the public markets, what information you need and how you use it is going to reflect your investment strategy. So for CalPERS in public equity, we're indexed. We run the money internally, so we have direct oversight of what's going on. And we know that engagement and proxy voting is the way that we can drive change. We have a very stable long-term holding in these companies. In our fixed income portfolio, which likewise is 96, 97% internally managed, it's actively managed. So the point of entry there for us in terms of integrating ESG analysis is in the due diligence, in the credit appraisal, as we're choosing to select particular holdings and securities. So with an actively managed portfolio, it will be a different approach to the integration of information to a public equity index portfolio. But in the private markets, there is tremendous opportunity. And I think as we get going, it will move very quickly because of the ownership structure gives more potential for influence by the GPs.
That's great. That seems like a business opportunity. Remy, I don't know whether your company going to do something, do the ESG evaluation for private firms. That's a huge market. There's huge demand as well. That seems very interesting. There's potential collaboration with for companies like CalPERS or some to integrate resources. In the end, we want to change the world. We want to use the way money talks to change the world, but how to do it, public and private market should probably join the force. Here I have a specific question for Laura. So the other day I was checking this Vanguard, one of the Vanguard ESG fund. It's very, very popular ESG fund. And it has 99% correlation in terms of holding and performance with Vanguard's one benchmark index, although the only difference for those two funds is one claim is ESG, another is not claiming ESG. And what's the difference? Performance is similar and holding is similar, but the ESG fund charge more than 50 basis point management fee for that one thing. Is that a tax for the investor? Just thinking about it. It's pretty much investing on the benchmark, but just because the fund use the name of ESG, you have to pay such tremendous money for that. I don't know. How about this? What do you? How invest can truly tell this the ESG thing? How BlackRock think about these things in terms of pricing for your funds and advertising? Thanks.
Yeah. No, that's a very good question, and it's very much something that it's part of our strategy. Is something that we strive to do, is to offer the same pricing or lower pricing for ESG strategies versus traditional strategies. Sometimes that is difficult because the reality of it is that ESG indices use more data and more insights than traditional strategies, right? When you start incorporating other elements to a traditional benchmark, you are also incorporating those data, and you have to pay for those data and those insights. And so that's really the difficulty, I would say. But I think that the intention is very much that of making this available at competitive prices for everybody, right? That's what we're in the business to do. We're in the business to offer these exposures to our clients so that they can build a portfolio with building blocks that are sustainable versions of traditional exposures, and at the same price or less. And so that's very much something I believe in. That's really why I came and worked to work in the ETF and index side of the business. And then in terms of, look, at the end of the day, you also have to balance in product construction when you're building a product. You have to balance the appetite for of our clients for having sustainable in it, but also at the same time not taking a huge amount of active risk versus the traditional benchmark. And that's a really difficult line to walk on, by the way. And so we by the way, here too, we offer options, and we certainly have products that are replicating much more closely their traditional benchmarks, but within very, very small tracking errors. And perhaps on sustainability, you have less improved performance. But then you also have products that take much more active risk, where you can really, with more conviction, invest in a certain theme or really pursue a certain view of the market. For example, around the transition to low carbon, you take more active risk, but you also have a significantly different weight of companies compared to the traditional benchmark. And so that's really the balance. I can tell you that, clients sometimes want a little bit of both. And that's why sometimes products are similar to their traditional counterpart.
Okay.
One point to add just on the this range of options, if you want. It's true that sometime under the same banner of ESG, you can have actually quite different approaches, and maybe one to give a sense of some easy numbers. If you define ESG as I only want to avoid certain types of companies that I find problematic, then you may end up having something which excludes maybe 5 to 10% of the universe, because you've defined it in a way as just getting rid of certain very specific types of company for specific activity. You have other notions, if you want, which are, for example, trying to capture the leaders across all the sectors in the market, and you have indices that would capture half the market, if you want, only the leaders by sector, and that would be, to Laura's, example of the sort of tracking error or active risk that you take. Obviously, that's further away from market cap, but it's starting to look like really something different. If you want, it's half the market, and then you can go even further and then exclude also entirety of sectors that you may find problematic. For an example, you can get rid of the entire energy sector because it's linked to fossil, and that gets you even further, if you want, away from the starting universe. And sometimes, the label, is ESG, but what's behind the label can lead to quite a lot of differences. And I think it's part of this education and learning curve where, today, again, people may stay at the label element, but it's also part of, again, adoption education that, it is important actually to go further, understand really the approaches. And I think we're also getting into another stage, which is also to provide more transparency on the characteristics of those ESG funds, or so that it's easier in a sense to know whether you have something which is only excluding 5% or something which really get half the market, but or not. And again, BlackRock definitely is in this camp of providing as much information on the ESG characteristic as they would provide on the traditional metric, which we think is really, really important.
Thank you very much, Remy.
Yeah, and if I can just add one thing, I think the transparency angle is really important, and that's why when you go to iShares, for example, and you see any product, you have a bunch of sustainability characteristics, and so you can see pretty clearly, and you can compare. There's also a compare tool, and you can just take a traditional exposure and a sustainable, and you really see what drives the difference, and you see the sustainability characteristics. And then I also found a stat that I had here, but to our, when we researched the fees angle, and we found that active sustainable equity mutual funds, for example, are about 5 times more expensive than our iShares sustainable ETF. So it goes from 115 basis points on average to 22 basis points for our product. So I think on the fees, we're really trying to help our clients there.
Okay, thanks, Laura. Great. So before our ESG panel, the New York Stock Exchange President Stacy talked about money talks. So that is the way finance can change the world to make the world more greener and to do more sustainable investment. The point is, does money really talks? We all hear from investor side, from the standard reporting side, from the pension fund. Does ESG investment, in particular the divestment, really change the firm's behavior to become greener and more responsible? I like to hear the answers. I saw Anne is shaking the hand, but I like to hear that. But if you disagree with that, money does not talk, what else could finance do to make the world greener, to make it more sustainable? This is I like to hear opinion. Thanks, Anne. Would you like to start? But limiting your talk to within 2 to 3 minutes so we can finish timely. Thank you.
Yeah, in highly liquid public markets where it's very easy to buy and sell, and the New York Stock Exchange is obviously an important platform for that, divestment simply means that I sell my shares to someone else.
Right.
It's in a secondary market. It does not impact the company's finances very indirectly. The debt markets, it's another matter. We can talk about that separately. But what we do is thereby run the risk that the company continues producing the emissions or causing whatever the problem might be, the impact on biodiversity, on water shortage, or workforce issues. By walking away from the company, we're not affecting it. Second point, the focus has been on the producers of fossil fuel energy, oil, gas, and coal. And CalPERS doesn't invest in thermal coal because we don't see a transition option for the industry. But for oil and gas, these are the energy suppliers to about 80% of the world economy. So just by selling your shares in the production side, you've still own 80% of the emissions in the demand, in the usage of that energy right across. So then the question is, well, we can't sell everything. What we need to do is to transition, to transform, to engage these companies to build out the new strategies. Now, as I mentioned, we have 111 of these largest emitters committed to net zero by 2050. That's come through investors making the request and require that companies do this. And then you'll also see that when companies aren't willing or able to make the response we expect, we will replace the board members. And that was the example of Exxon, where there've been engagement with big investors over many years on governance issues, risk reporting, financial performance, and more. So now that the market understands, it's not just that money will talk, and I agree with Stacey on that, money will talk, but money will act. And the more that investors come to realize the critical need for climate competent boards, not just boards that are independent and diverse, but also competent on these transition issues, I think we'll see more of that, of those votes ensuring accountability. Likewise on the auditors. Right now, there is a deafening silence from auditors regarding accounts that currently do not reflect the Paris commitments that companies are making. So that's got to be a gap that's closed too.
Great. Granville, what do you companies that try to set up the standard for these things? What do you say we finance can do a better job in terms of make the world greener?
Well, I would just build on a lot of what Anne said. You know, the role that disclosure has to encourage and push companies to make concrete their strategy and CapEx around pledges to reduce their emissions. Many companies have, but many more need to make concrete their pledges to reduce emissions. And you know, the fact that we have seen this substantial surge in net zero commitments is really a direct result of investor engagement. And so, you know, your question, what can finance do? Anne touched on a lot of it. The surge and then the implementation of net zero pledges is something that finance not only has done, but is likely to continue to do. But there are limits, there's no doubt. You know, in the disclosure area, you know, disclosure would look fundamentally different if, for example, in the United States, you had a meaningful carbon price. And the connections to cash flow statements and income statements in the environment of a real carbon price, you know, would be visible. And, you know, right now we don't have that. And so government policy is critically important to really capturing the catalytic effect that the financial system has on operating companies. And, you know, whether or not we will see that in the US is an open question.
Great, thank you. Given the time, I'd like to finish this panel with last round of very, very brief questions. Clearly, all of you are the expert on ESG. My question is, what do you don't know about ESG, but you are curious to know about ESG? You have, each of them have 45 seconds just to answer that question. Remy, please start. Sorry to give you a short preparation time.
Oh, what I'm curious, if you're on, it's like, there's so many things we're going to do in terms of modeling, processing new information, thinking about new concepts. Again, I think with Laura, we actually exchanged, you know, during the summer on new metrics, on, on measuring how companies are aligned, on a 1.5 or 2 degree path. So there's so much, that we actually don't know, but should invent that. It's more like being a kid in a candy store, if you want, in terms of, thinking through concept and designing new metrics. So I'll stop here because I could go on forever on this topic.
Okay, Laura.
Yeah, I agree. It is really fun to be in this in this space, especially on the research side. So I can't complain. I think that one aspect of ESG that I think will be interesting will be thinking about how can we build better signals for not just where the companies are today, but where they're headed, right? And so Remy talked about some of these concepts around alignment with climate goals, and I think that we can expand that to also other aspects of ESG, really thinking about here's where the company is today, but where is it going to be in 6 months? Where is it going to be in a year? How can I gauge that? Because that's really the insight that I think can really help you drive performance and also drive change in the real world.
I totally agree. Granville, last closing.
I'll end where I started. In the near term, we're going to see much more robust disclosure coalescing around standards that are going to come out of the SEC at the European Union level, and as I've said, the ISSB. And I think that portends very positive developments for the ESG rating space, for folks at the asset managers who are trying to make decisions and build products around reliable and comparable data. So I think that's a good news story in the near term, but an awful lot of work remains to be done.
Great, thank you very much.